This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
In any examination that you sit, given the nature of objective testing questions, there are always going to be some questions that you cannot deal with. We have a very big syllabus. There's a huge amount of detail. So we can't legislate, nor must we worry about dealing with every possible question. But what you must do in terms of exam technique is to ensure that if you do have the knowledge to be able to correctly answer any individual question, that you use that knowledge in the right way and secure the right answer and therefore the marks. There is nothing more infuriating, more costly in terms of your exam performance than if you forego, you give up marks that you could and you should have scored. Now, if you've done the reading that you'll see on the screen in front of you here, based on the things I've already told you so far, we see here a perfect illustration of where although students will possess the knowledge to get questions right, they will make silly mistakes and therefore miss out on those marks that they could and should have scored. This is the type of error that you have to ensure that you deal with and you do not make these mistakes in the exam. And most of this comes down to not rushing the question. Too many people do not look in detail at the requirement of the question or indeed fully understand the information provided within the question. In their haste to press buttons on the calculator, which they do very quickly, they don't always press the right buttons. Or if they do, they don't always go to the end result that is required of them. So it is critical, therefore, that you read the information in the question and analyse the precise requirements of that question very carefully. Only when you have decided that you know exactly what needs to be done and the means by which to do it, do you then proceed to start pressing those buttons on your calculators, but do not rush in. So, as you will hopefully have read since last time, we can see here that, again, when we're dealing with calculations of CGT, it is even more important than ever to ensure that you properly read and understand the information provided in the question. Now, here are the typical examples. Does the question give you the figure of taxable gains? In the exercises that we've done so far, I'll be giving you both taxable gains and taxable income. And that was then used as the basis from which you could then compute the CGT liability. Now, you know that taxable gains is after having deducted any capital losses and, of course, your AEA for the tax year. So, does the question give you the figure of taxable gains, or does the question tell you the chargeable gains and you then have to compute the taxable gains? They might give you the net gains of the year. Those net gains, gains less losses, will be before deducting any AEA. You have to deduct the AEA away from the net gains to be able to establish taxable gains. Obviously, if you have capital losses brought forward as well, then those two must at the very end be dealt with, if of course there's anything to deduct them from at that point in time. But what you may get is taxable gains, so that's the figure after AEA, or net gains, which is before any deduction of AEA. So it is also going back to Chapter 2 under your understanding and awareness of the structure of the income tax computation. Again, up until now in these exercises, we've been looking at a figure of taxable income of the taxpayer. Bottom line, taxable income on that first part of the income tax computation before moving into the tax liability calculation. Now that bit of course is not required here in CGT, but we do need the taxable income figure. Now you may be lucky and they may, as I have up until now anyway, just given that figure to you. That taxable income figure is therefore after having deducted any personal allowance of the taxpayer for the tax year. So does it give you the taxable income of the taxpayer for the tax year, or are you simply provided with income figures that require you then to deduct the personal allowance of the taxpayer to compute the taxable income. So net gains, not the same as taxable gains. Net income, not the same as taxable income. We will need, if a CGT liability is required of you, to compute, we will need to know taxable gains, taxable income. Do they give you those figures as a starting point, or do they give you net income and net gains from which you respectively deduct your personal allowance and your AEA? Make sure you interpret that information correctly. I've received on the Ask the Tutor questions forum many questions over the years where someone say, why have we deducted the AEA, or why haven't we deducted the AEA? Why have we deducted the personal allowance, or why haven't we deducted the personal allowance? Simply based on students not having read the information provided within the question. So make sure you get that right. In addition, read carefully, as we've said, the requirement of the question to ensure that you're actually answering the question's the correct requirement. So, for example, does it actually ask you to calculate the CGT liability? We'd probably expect it would do, of the taxpayer, or simply to compute the taxable gains of the taxpayer. They may give you individual assets with market values and or sale proceeds there, your allowable costs, and you've simply got to work out what the net gains of the year might be. And then the taxable gains after deducting any AEA. They don't necessarily always ask you to compute the CGT liability, so make sure you're answering the correct requirement. Does the requirement ask you to compute the taxable gains after AEA and losses brought forward, or simply the chargeable gains before AEA and losses brought forward? Again, what do they want? Do they want taxable gains? Do they just want net chargeable gains? Do they want CGT liability? Make sure you correctly interpret the requirement. So, as we've said, you do not rush into those calculations. You don't waste time either. It's an exam. There is a strict time allocation, of course, to be adhered to. But you make sure before you start to jot things down, calculations down, press buttons on your calculator, make sure that you know what needs to be done. You correctly interpret it, well, at least as best you can. Let's see that, therefore, in action with some examples now. Example 2 here. We've got to compute Matthew's capital gains tax for the 1920 tax year. Now, this time, what information do they give us about Matthew? That he has a trading profit of $20,000 assessed in the 1920 tax year. Again, if they wanted to, they can mix skills up here. They may give you trading profits for maybe 2 or 3 accounting periods. And you have to, using your current year basis of assessment, establish which of those profits is to be assessed in the 1920 tax year. I've just presented the figure to you here. But any knowledge that you had in preparing that income tax computation could be tested in some small way here. Again, in a 2-mark exercise, there's a limit to how much they can ever ask you to do. But they may mix the skills between both income tax and capital gains tax. So we've got a trading profit of £20,000 for 1920. So we're given information about income, we are not given the taxable income. And we sold an antique vase, giving rise to a capital gain of £18,000. So we're given income and gains figures. We are not given taxable income and taxable gains figures. Those are what you now have to compute. So you know what the trading profit is, £20,000. That would go into your income tax computation. It's the only source of income, so it would be your net income here for, well, Matthew's net income. But you would have to deduct your personal allowance to give you taxable income, the basis upon which then any CGT liability can be computed. Very obviously here, with only £20,000 trading profit and a £12,500 personal allowance, there's very little taxable income. There is therefore a very significant remaining available basic rate band for you to use your relevant CGT rates. Now, this is an antique vase. This is not an asset that would benefit from entrepreneurs relief. It is not residential property. It is therefore the CGT rates applicable to every other asset. 10% in the basic rate band, 20% in the higher rate band. Therefore, how much capital gain do we have? 18,000. Is that the taxable gain? No, it isn't. You therefore must compute that taxable gain by deducting the AEA. You then can see with those numbers that all of that taxable gain is going to be within the remaining available basic rate band. Hence, the lower of the two rates, the 10% tax rate will apply. Okay. You've then got example 3 to have a go at. This time we've upped the figure of trading profit for here, Katie in this example, to £41,000. The bigger the figure of income, then the closer you get to having used up some, well, not some, always some, but maybe the majority, if not all of the basic rate band that is available to you. Now, you know in income terms that the basic rate band goes up to £50,000. Where does that come from? Well, you've got a basic rate band in terms of taxable income of £37,500 before, of course, extending that basic rate band and, if necessary, higher rate band by the gross amount of any personal pension contributions or gift aid payments. But your taxable basic rate band for taxable income is 37,500. Taxable income is after deducting the personal allowance. That's 12.5. So 37,500 taxable income is after deducting 12,500 personal allowance. Add the two numbers together. That's an income figure of £50,000. So here, with a trading profit of 41, we're still going to be within the basic rate band. What did she sell? A commercial investment property. Commercial, not residential. So we're back to our 10% and 20% rates. This is not an asset, being an investment asset that would rank for entrepreneurs relief, but we'll learn about that in chapter 14. And clearly it's not residential property. How much gain do we have? A capital gain of 30,000. Again, no pun intended, again, we have the capital gain there, and that is before deducting your AEA. You will need to deduct the AEA, get the taxable gain. And you should, just by looking at those numbers, given what I just said, be able to see that when you take that taxable gain and you compare it with the remaining available basic rate band from your income tax computation, that the taxable gain will be bigger than that. And what that means is the first part of the taxable gain will be at 10%, and the amount that is pushed out of basic and up into higher rate band, well, that will be taxed at 20% there. Okay, I'd like to have a go at those two examples before we take it any further. I've talked you through, should therefore now know what to do. Perform those exercises, come back. I'll quickly, of course, go through those answers with you to ensure that we don't have any problems with them. And I don't expect you will have any problems with them indeed. So you crack on with those now, please. Okay, well, hopefully you had no problems in dealing with those exercises, but let's make sure we've understood what's in the answer here. We know that to be able to establish a CGT liability, you clearly need to ascertain the taxable gains. You then need to know the taxable income so that you can establish the CGT rate or rates that will then apply. So a single figure of gain of 18 less our AEA of 12,000. So we're talking about taxable gains of £6,000. Single figure of income 20,000 less the personal allowance. Taxable income 7.5. The basic rate band available in the income tax computation is 37.5. We've only got £7,500 of taxable income, which leaves an available, a remaining basic rate band of 30,000. More than enough to absorb that taxable gain, meaning that as it's not residential property, it's not an asset that attracts entrepreneurs relief, it is the 10% rate that applies on the full 6,000, and that therefore will equal £600. If it were relevant, if it were required, it wasn't here, but we know that the CGT liability is due the 31st of January following the end of the tax year. Our tax year 1920, therefore the following 31st of January 21. Taxable gain of 6,000 therefore falls wholly into the remaining basic rate band, so the CGT rate is 10%, as the gain is not on residential property, as we have said. If the taxable income of the taxpayer had been 32,500, in that case, only 5,000 of the basic rate band would remain, taking you up to the £37,500 of normal basic rate band taxable income. If we'd only got 5,000 left and 6,000 gains, that's going to push 1,000 of the taxable gains into the higher rate band of 20%. Now that, of course, was then the situation that you faced in the second exercise, example 3, where we had a much higher figure of taxable income, though still within the basic rate band, but when we applied the taxable gains to that, it took us through the remaining basic rate and up into the higher rate band for gains. So again, what do we need to know? We need to know taxable gains and we need to know taxable income. So all we do to get the taxable gain, deduct the AEA from the given figure of gain. To get the taxable income, deduct the personal allowance there from the given figure of trading profit. Once we've got the taxable income, 28,500 here, we can now, as we are a basic rate taxpayer, see what remains of the basic rate band. 37,500 minus the £28,500 of taxable income leaves a basic rate band remaining of £9,000. We are looking at taxable gains of 18,000. Therefore, well, a nice even split, the first 9,000 of that £18,000 of taxable gain there, that falls into and will use up the remaining basic rate band, so will be taxed at 10%. There's your 9,000 at 10%. The remaining 9,000 out of your 18,000 in total is therefore pushed up into the higher rate band at 20%. Do your calculations, and if needed, you can then work out and establish your CGT liability date, as well as the amount that would be due at that date. Now, what we've seen in both of those examples is that the basic rate band available for purposes of dealing with your income tax computation and now for dealing with your CGT liability calculation, that's based on 37,500, a figure we've known ever since Chapter 2 there. But of course that basic rate band may be extended. If the taxpayer during the tax year had made either of two payments. If we had been talking in terms of personal pension contributions, then the gross personal pension contribution would extend the basic rate band, and or any gift aid payments, any charitable donations through the gift aid scheme to charity there, once again, the gross amount of any gift aid payment would further extend that basic rate band. When we say the gross amounts, you got to read the question to see whether they tell you that the figure is a gross figure. But if all they say is that is the amount paid, that is a net figure, and that must be multiplied out by 100/80 to account for the basic rate tax relief given at source. And we extend then the 37,500 basic rate band by that gross figure. There'll be no relevance here for us in CGT in terms of extending any higher rate band. Once we go above the basic rate band limit, it's 20% in relation to CGT here. If dealing with residential property, it would be 28%. It doesn't get any bigger than that. So as soon as you go above the basic rate band available, that's it, you move to the higher rates. Now, if we go back to our examples and look at example 4, then that's what we see happening here. We've got to, again, calculate, this time it's Elliott's capital gains tax for 2019-20 tax year. Got a trading profit of 45,000, so again, a figure of income provided to us for our 19-20 tax year. Sold a painting giving rise to a capital gain of 26. So we've got the income figures, we've got the gains figures. We again, as ever, need to take the income and work out taxable income, take the gains and work out taxable gains. But this time, in terms of the taxability of the taxable gains, in terms of working any remaining available basic rate band, we're told that he made a payment of £2,400 in 1920 tax year, and that was a gift aid payment. You do not see reference next to the 2,400 to indicate that was a gross figure. So that is the amount paid, that is net. So that therefore needs to be multiplied by 100 over 80 to establish the gross amount. And we will then extend the 37,500 basic rate band by that figure. And with that revised total, we will compare our taxable income to see how much remaining basic rate band is available in terms of your CGT calculation to establish your CGT liability. It will, of course, inevitably mean that still we push some of those gains, taxable gains, out of the basic and up into the higher rate band. You've got to work out, therefore, yet again, the mix of what is 10% and what is 20%. Again, it's those rates, of course. Sold a painting. This is not residential property. It's not a business asset eligible for entrepreneurs relief. So it's 10 and 20%, the normal CGT rates there. Okay, have a go at that exercise now. And again, then we'll quickly review through to make sure that we've conquered that particular obstacle as well. Okay, well, hopefully again you incurred no major problems in establishing the correct answer here. What do we always do? We always need to establish the figure of taxable gain and the figure of taxable income. As we have seen all the way through these basic examples, all that required us to do was to deduct the AEA from any gains made in the year to get the taxable gain. In terms of our taxable income, to deduct the personal allowance from any income that we had to get taxable income. As soon as you had the taxable income, you would establish the remaining, if there is one, available basic rate band. Now, as that's £32,500 of taxable income, we are still within the basic rate band. What is normally a basic rate band, of course, of 37,500. But the difference this time was that that basic rate band needed to be extended. Needed to be extended by the gross amount of the gift aid payment. Our normal basic rate band, 37,500. The amount of gift aid payment made, the actual payment, 2,400. That is a net figure. We need the gross figure, times 100 over 80. That will take the 2,400 and gross it up to £3,000, therefore. That means that instead of having £37,500 of basic rate band limit, extended by 3, that goes up to 40,500. 40,500, therefore, minus the £32,500 of taxable income off your income tax computation, leaves us with £8,000 of basic rate band still available to feed into your CGT calculation. So what figure of taxable gains did we have? 14,000. That's bigger than 8,000, so it uses up all of the 8,000 remaining basic rate band limit. It still leaves out of a total of 14,000, 6,000 to be assessed. That now falls into the higher rate bracket, and therefore it's 20%. And in that way, we're able to establish our CGT liability. So, same exercise. If they haven't given you taxable income and taxable gains, you compute taxable income and taxable gains, deducting personal allowance, deducting AEA. If we are still a basic rate taxpayer, or appear to be a basic rate taxpayer, then of course we need to work out any remaining basic rate band that is available to us. Remembering now that that basic rate band limit, normally 37,500, has to be extended by the gross gift aid and or the gross personal pension contributions made. Once done, do we now have any remaining basic rate band available? If so, use it. If the taxable gain is bigger than the basic rate band still available, then the excess is at the higher rate. Those rates that we have used here have been the rates applicable to other assets, as we have seen there. We've not yet dealt with a residential property where the higher rates apply, and not until we deal with Chapter 14 will we be dealing with assets whose gains will give rise to the availability of entrepreneurs' relief. Let's have a look then at what is now required in our next exercise, example 5. It's still CGT liability for our tax year, this time for gainer. So what have we got? A trading profit assessment. So they're giving us the income figure, £21,500 in the 1920 tax year. No other taxable income. Very clearly, therefore, gainer is merely a basic rate taxpayer. Now, she sold 2 assets during the tax year. A residential investment property, giving rise to a gain of £30,000, and a diamond ring, yielding a chargeable gain of £12,000. Now then, I've not emphasised an important word there, but given the introduction to this, I hope you have picked up on the fact that that first gain of £30,000 was on a residential investment property. Residential. Up until now, it's been commercial. It's been business property rather than a residential property. As soon as you see residential property, we are talking in terms of the higher rates. Now, there's not just one gain, there's 2. In relation to the residential investment property, we know that there is basic rate band available. You are still to compute that figure. But you then know that residential property would have 18% and 28% rates applicable to them for any remaining available basic rate or any higher rate thereafter. And we've got a diamond ring, which is just an other asset. And of course, on that, we'd be talking about 10% and 20%. So that gives us an issue that we referred to in a previous lecture. We've got to get our taxable gains. To establish the taxable gains, we need to, from any net gain figure, there are 2 gains here, we need to deduct our AEA. So that begs the question here that if I've got 2 different gains of 2 different types of property, I get to choose where to deduct the AEA. Now I'm going to deduct it where it'll do me the most good, save me the most tax. So, against which of those 2 assets, the residential property, hint hint, or the diamond ring, do you think we would now be deducting that AEA? We obviously want to deduct it from those gains that are taxable at the higher rates. Residential property in the basic rate band is 18%, compared to the diamond ring that would only be 10% there. Go into the higher rate band, 28% instead of 18%. So we're always going to apply deductions. Here it's just the AEA, and probably will be an exam question. But if you'd had a third asset sold during the period at a loss, then you would be able to net that loss off against, yet again, the gains that would be taxable at the higher rate of CGT. You could deduct that from the gain on the residential property in priority to the gain on the diamond ring. So what this is doing is to test out where we've got a mix of gains where different rates apply, any deductions, losses, AEA, that can be taken away from any figure of gains, deduct them from those gains taxable at the higher rates. Residential property is taxable at higher rates than normal assets there. Normal assets at 10 and 20% would be taxed at a higher rate than those that attract in its entirety entrepreneurs relief, where the rate would only be 10%. But that, as I say, awaits us in Chapter 14. Okay, time for you, therefore, to have a go at example 5 and see whether you can crack that particular problem. An interesting addition to the exercise here. Over to you. Okay, let's see how we've fared here. We've also, if you've reviewed through all of the answer already, seen that we've made another additional statement at the end, which we'll explain in a few minutes' time. Again, obviously to compute any CGT liability, we need to establish taxable gains. This time, the two types of asset we have different tax rates applicable to them, so we separate out the gain on the property from the gain on the ring. We know that the residential property has the highest CGT rates, so it is the one that benefits from that AEA. See the note there. The AEA deducted firstly from the gain on the residential property. As we said before, it's subject to the highest CGT rates of 18%, as it will be here. If it fell then into any higher rate band, 28%. Now that, of course, is a higher set of rates than would be applicable to the diamond ring, just another example of another asset, where would be 10% and 20%. So what do we do? We now need, of course, to, having got taxable gains, to get taxable income to know the remaining basic rate band. Now you can see here I haven't done a separate little mini income tax computation. Remember, in the exam, you are answering here objective testing questions. And what that means is there's no marks for workings. There is only their marks, 2 marks indeed, if you got the right answer. So it's not about presentation, but you have to use a presentation that allows you to avoid errors and to secure the right answer. So what I've done this time is just to, rather than do a separate calculation of on your income tax comp, I've just done it in note 4. So taxable income of gainer, the income figure, 21,500, minus the personal allowance of 12,500 equals 9,000. That's the figure that we wanted. The amount of basic rate band that would be used up by the taxable income figure. As soon as we've got that, then 37,500 is your full basic rate band available. We've got £9,000 of taxable income that will therefore leave to be utilised within the CGT calculation now an unused basic rate band available of 28,500. This just has to be a jotted note for you. Now again, it has to be done in such a way that you clearly understand what you're doing and it leads you without error through necessarily to the correct answer. But you do not need the formality of a CGT computation, of an income tax computation. You know what needs to be computed. Do it in the quickest and easiest way that you can, but in a way that will avoid errors. Don't take shortcuts here. Make sure you get it right. So what have we got? We've got there unused basic rate band of £28,500. As the gain of 18,000 on the residential property falls entirely within that remaining basic rate band of 28,500, it will be taxed at 18%. So what you see happening here, we have deducted the AEA in priority, which is the essential issue, from the gain on the property as compared to the gain on the ring. And we then just proceeded, I would imagine that you probably did this as well, to tax the gain on the property first. That was 18,000. It's in the basic rate band, which on residential property is 18%, which hopefully will equal that figure. We then have the gain on the ring of £12,000 to tax. Are we still within the remaining basic rate band? Yes, we will. We had taxable income of 9,000. It meant for CGT purposes, we had remaining and available basic rate band of 28.5. We have just used out of that 28.5, 18,000 in relation to the gain on the residential property. That means that 10,500 of remaining basic rate band is available to us to apply against the gain on the diamond ring. So there you go. There's your 10,500 out of what was a figure of 12,000. That takes you up to the basic rate band limit, and that therefore means that of that 12,000, it pushes £1,500 up into higher rate, tax therefore at 20%, and that therefore will give you £300. Add it up, get your liabilities on each of those assets, giving us a total CGT liability of 4,590. Now, it may not even have occurred to you to have done the calculation in terms of the CGT calculation in any different way. That we had applied AEA, we would equally apply any losses available against the gains on the property because it bears the highest CGT rates. So the taxable gain needs to be reduced as much as is possible, therefore saving tax at the higher rate. But once you've actually got those figures of taxable gains, as we had here, 18,000 and 12,000, what this note goes on to say is then it doesn't matter what order you actually tax those taxable gains in. The reason being that it doesn't matter that the rates themselves are different. The difference is between the basic and the higher rate in each of the categories of residential property and other assets. The difference between the basic and the higher rate is exactly the same. You either go from 10 to 20, a difference of 10%, or you go from 18 to 28, same difference, 10%. So actually it wouldn't matter. Now, again, if you never even worried about it, never even thought about it, fine, absolutely no problem. But if it was worrying you, don't let it worry. You can do it in either order. Personally, I'd have just done it as we did there. It seems to make more sense. Actually, it doesn't matter. So do it either which way. We've explained that here in that note and then proceeded to show a revised calculation where we would tax firstly the gain on the ring and then go back to the property and tax the remaining part of that gain at the combination of basic and of course the same amount, a little bit there, of 1,500 at the higher rate. It doesn't matter what order you do it in. Okay, so have a little review through that and hope that therefore that will settle your mind in relation to that particular issue, even if indeed it was giving you a problem. It isn't a problem, it doesn't matter. Okay, so plenty of practice in terms of this session, so hopefully you're feeling stronger now in terms of your ability to deal with an examination question that involves the calculation of a CGT liability. We'll bring this particular session to an end at this point in time. Obviously, you can see then what we go on to the section on disposal proceeds. But what that will do is just take us back with a little bit of new stuff, a few new things coming in, but then a repetition of what we've seen before, looking at the content of the capital gains tax computation. So your capital gains calculation, the disposal proceeds, are there any issues there? Your incidental costs, your selling expenses, what examples do we have there? Your allowable costs, where do they come from? What do we include as an allowable cost? And where there are losses, are they current year losses? Are they brought forward losses? How and where do we use them? We've just been seeing, of course, in that instance, about where an AEA has firstly reduced gains taxable at the higher rate. It would equally be true, as we said, in terms of dealing with losses. So just have a little read through that. You can see I've written something there for next time. Don't worry about that. I'll explain it to you. But just have a little read through down to that losses section. Don't worry about example 7. I'll lead you into that, and you'll be doing that along with many other examples next session.